Good afternoon and welcome to the Spring 2023 Linneman Associates Capital Markets webinar presented by Linneman Associates in Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of financial analysis tools and training to the CRE business since 2009. We're pleased to have an insightful program for you today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which for those of you who do not know, is a strategic and investment analysis advisory firm. We're using the GoToWebinar platform, and I'll address a couple of housekeeping items to make sure everyone's comfortable. On the audio front, all of the participant audio is muted, meaning we cannot hear you, and that's by design, and that will remain the case throughout the entire webinar. If you're attending by computer, take a moment to familiarize yourself with the control panel elements. We'll be showing the slides in the broadcast window. If you'd like to download them, you can find them in the handouts section and just click on the file name and it will download. You don't need to have the slides up because we'll be showing them, but you are certainly welcome to keep them for future reference. As always, we've reserved 15 to 20 minutes at the end of the webinar to answer participant questions, but please feel free to submit your questions at any time by clicking in the questions field of the control panel box, typing in the question, and make sure to click the send button so that it comes through. And if at any point you get disconnected, just reconnect how you signed in initially. And if you're registered, you will automatically receive an email link to the recording of the webinar about an hour after we finish today. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, how are you doing today?
Doing great, and it's a lovely day here in Philadelphia. I'm just back from an amazing and interesting and wonderful trip with my travel friends, my dear travel friends, where we did Azerbaijan, Georgia, and Armenia. We saw a lot of very interesting things. The most interesting economic thing we saw, Bruce, was mile after mile after mile after mile after mile of thousands of trucks in Georgia lined up on the side of the road waiting for permission to go through the pass into Russia. And this has all been since the sanctions were imposed. And so if you wonder why the sanctions have not been as biting as you might have thought on Russia, it was very insightful to see this unbelievable amount of truck traffic waiting to go through. So much so that they had to have the trucks wait on the side of the road during the day for several days in some cases, so that they don't just bring traffic to a complete halt. So when we talk about what's going on in the world, that was an amazing visual education. So go to the first slide, Bruce, and I'll focus on the US. Start out with what I've come to call economic long COVID. That is, things that are associated with COVID policies here and around the world, and they have been very slow to go away, not instantaneously solved. We still have real GDP lagging the pre-pandemic trend. We still have lagging labor force participation and employment, and we'll touch on that. The supply chain problems have largely been solved, although there are still some. Inflation, it's funny how inflation is now the most discussed item in the news, even though most people have no idea what it really is. And in fact, it's very interesting that the people at the Fed and at other agencies who are trying to form inflation policy, if you think about it, it has not been a seriously studied topic in graduate schools since the 1970s and early 1980s. When we had high inflation. That means that anybody who has basically been trained or gotten a PhD in economics or finance since 1985 really had no exposure to what inflation was, because it's not been an issue. This is important, and I think, to understand how overmatched people are in terms of making inflation policy decisions. And I say this because I'm 72, Bruce, and I did my PhD in the 1970s, went into my career in the late 70s and early 80s, and it was a highly, highly studied topic at every level, starting with how consumer price indexes are put together, through the various metrics, through should asset inflation be and what difference does it make, to the housing price lags. No one trained in the last 35 years has any particular insight on that. And it's kind of a lost generation of research, including, is there a Phillips curve? So as I talk about inflation, you'll see that we have erratic monetary policy, because monetary policy has really not had to deal with inflation in any meaningful way for 40 years. And then the last is a drunken sailor fiscal policy, which originally started out as emergency relief and is now morphed into, gee, spending is fun on both sides of the aisle. Go to the next chart and we'll pick up some of these themes. First, if you go, is real GDP. Real simply means adjusted for inflation. You can see the potential inflation if pre-pandemic growth had occurred. That's the lighter blue line at the top. The dark blue line is actual, and the red is just to do for your eye where we'd otherwise be. So you can see actual is still below pre-pandemic trend by about 2.5%. Another way of saying that is it's been now about 3 years since the pandemic began. We normally would grow about 2.5% a year for 3 years, and we're 2.5% behind. So in fact, in 3 years, we grew 2 normal years. That is to say, there's a pent up in the economy of a year's worth of normal growth, plus the growth that would normally happen over the next 12 months. I think that's a useful way to think about it. This shows very clearly the economy is not overheated. If it was way above trend, you'd say, yep, we have an overheated economy. The old comment, you have to take away the punch bowl before the party's over. The party hasn't begun. We're coming out of a depressive situation. And so it's not time to take away the punch bowl. Go to the next chart, picks up private sector employment. And again, you see that while it's almost back to its potential, it is still slightly below. Again, you see pre-pandemic trend, you see actual. It's interesting, actual has been adding jobs since mid-2020. People keep saying, gee, people are never going to come back to work, and every month they come back to work, more and more and more. That's been no surprise to us. That was always our prediction. So employment is coming back in line to where we would like it to be. Go to the next couple of charts and you'll see how bizarre it was. The next chart is initial unemployment insurance claims, the percent of the labor force. To scale it, to allow the shutdown to appear on this chart, you make the terrible upswings in unemployment insurance claims in the early 70s, the early 80s, the financial crisis, 1990, all look like nothing. So you get a sense of how unusual, how bizarre, and remember, created not from economic forces, but health and political forces associated with concerns on health. It is remaining low. However, over the last 3 weeks, it has risen to a level that gets my attention, as you got to watch it, but not a recessionary kind of number. but certainly watching closely what's happening as the Fed wages war on the economy. Go to the next chart, the unemployment rate for teens and overall population, quite low. I like to take a look at teens because they tend to be an early and dramatic indicator. You do not see a sign of recession here yet. It is still quite low for both groups. And you would see teens moving faster because it's very easy not to replace a teen when somebody quits or goes to school or whatever. So that's looking really strong still. Go to the next. As I said, the Fed is waging war with the economy, and you've seen a downtick in the percent of industries adding workers, although it is still high. It is still high by normal standards. That is to say, coming out of COVID related restrictions, it's not surprising that all sectors of the economy picked up and sort of resumed. But as you know, the tech sector has pulled back, construction is pulling back. So you are seeing some reduction in this, but it is still an economy that's adding jobs broadly. Go to the next, you get another view of the labor market. Job openings, I've marked the high and the low just to help your eye. We had an abnormal situation of job openings as demand came back faster than the supply of labor. As we came out of the pandemic, you see it very dramatically. And we went to a situation where you had about 2 times as many job openings as we had people unemployed. This falling is actually a good thing as long as it's falling because we're adding lots of jobs. This would be a bad thing if it was falling because we are eliminating job possibilities and laying people off. We are not laying people off. We still have lots of job openings and we're still adding lots of employment. And is a good thing that's happening. Go to the next, labor force participation. I've only put in one age category here, 65 and over. The 65 and over has not recovered in labor force participation. All other age categories had a big drop in their percent of labor force participation, but they have all gotten back to pre-pandemic norms, pre-pandemic highs. This sector is an exception, and I note to give you how powerful
Peter, I'm not getting audio through on my end.
people 2 or 3 years away from retiring that lost their job just quit, dropped out. This is the main source of missing workers. There are a lot of other people who you wonder why they aren't working, but they have normalized in that regard. This sector is still a couple of percentage points off of being back to normal. This is the remaining labor force shortage, and it shows up in a lot of sectors. Go to the next. It's the percent of the labor force receiving some type of unemployment insurance, and you can see how dramatic it was. We were at 23% of the labor force just a little over 3 years ago receiving unemployment. It's come down. It's actually quite low. That's people are coming back to work. They'd rather work than collect unemployment. Yes, there are some that are scuffling in that regard, but not many. Go to the next chart. Consumer confidence has fallen dramatically as the Fed has waged war on the economy. You can imagine anybody with short-term or floating rate debt on the consumer side has gotten hit. Credit cards, for example, have gotten hit, and it has greatly reduced consumer confidence. However, it is still about average. So it's notably down due to the war on the economy by the Fed. I should say a needless war. But it is not recessionary levels yet of consumer confidence, hanging on at about average. Go to the next chart, where you have small business optimism, and it's clear that the regulatory burdens of the current administration have taken a lot of wind out of the optimism of that sector. You add to it the issues at regional banks, which are a main source of financing for smaller businesses, and there is not a lot of optimism in that sector of Main Street, and that's a weak point in the economy. Go to the next. Housing starts and auto sales, I've normalized them both to 100 so they can fit on a chart together. Couple of interesting things you see from 1976 really to about 2006, they move pretty similarly, not exactly. And then by about 2008, they diverge, with housing falling off a cliff while autos follows a pretty normal pattern. It is only in the last 2 years that you see the red line and the blue lines being on top of one another. The housing market took a terrible time to adjust. I've always maintained that it was because the zero short-term interest rates robbed, quote, grandparents of income on their CDs, etc. They weren't able to subsidize the down payments of the younger generation, and that put a long damper on the single-family housing market in particular. However, the movement in interest rates lately have pressed both of these down. That said, these are both sources of long-term growth looking forward because housing is massively underproduced. We'll come back to that in a moment. And autos have been massively underconsumed over the last 3 years. First, because nobody wanted to go out and buy them, or you couldn't go out and buy them. Then, because of supply chain issues, you couldn't get them. And then, because high prices discouraged. So there's a lot of pent-up demand for auto. There's a lot of pent-up demand for housing. Also, obviously, travel, tourism, leisure, which are still not back to their pre-pandemic levels. Planes are full, but that's because they've cut the number of flights. Hotels are full, but that's because the number of rooms is down about 10% versus pre-pandemic. Go to the next. So one of the most important things that I think is keeping the economy strong in the war with the Fed is that about 42% of all households in the United States have locked in mortgages around 2% or less. And those are 30-year mortgages. They're primarily fixed rate mortgages. Basically, if you think about it, it's 2/3 of all households own, and 2/3 of all households that own have a mortgage and locked it in over that time period. This gives them about 2 to 3% of their mortgage face value as extra spending power a year. And obviously it depends on the mortgage level, but for somebody with an average $200,000 mortgage with about $100,000 in equity, they're getting something like $4,000 to $6,000 a year more than normal to spend. This is going to keep those people in their homes much longer because when they sell, they give up the present value of that locked in low mortgage. So you're going to see slower turnover than usual of existing homes. that's going to drive people who want to buy more so into new homes. And it's also going to keep people renting longer than they otherwise would have, because there's not as many homes available because of this phenomena. So this is a very important phenomena to bear in mind. Go to the next chart. This is the cumulative shortfall of multifamily over the last 21 years. Basically, during the financial crisis, it went from being sort of balanced, more or less in balance, down to about 1 million unit shortfall. Nothing got built. Nobody could get financing to build. NIMBYism made it hard. 1 million out of about 44 million, just to put it in context so you can think of it as about 2% shortfall in multifamily. That has fallen to about 400,000, which is pretty much concentrated in a few markets and sub-markets. However, there still is a shortage of multifamily. But if you go to the next one, the best news for multifamily out there, in a way, is the shortfall of single family. Starting from 2000 to 2006, we got to a point of more than 2 million units more than we needed. Again, about 2.5% of the stock, 2% of the stock. And yet, as things shut down during the financial crisis, we got down to about 3 million, little more than 3 million unit shortfall, almost 3.5 million shortfall. And that's about 3.4% of the single family home market. That's a fundamental phenomena that will keep upward pressure over the foreseeable future on single family. In so doing, it also says multifamily looks like a good alternative in a market where homes, single family homes, are undersupplied. And it's a good long-term position. And it has some things to do with NIMBYism. It takes a while to work out of that. It's not going to be worked out of in a hurry. Go to the next chart. Household financial obligations as a percent of their disposable personal income. Remember, I mentioned they had that $400,000, $500,000 on average spendable power. And the headline, the red marks average. The headline is how financial obligations as a percent of disposable income has risen from the bottom of the pandemic, which it has. But you can see that it is still way below any kind of historic norm, anything it was in the 2010s. People have cushion. Households have cushion. Go to the next chart and take a quick look at the corporate sector. Real corporate profits are high but flat. If you look at the red, they're high but fairly flat for the last year or two. Now remember, if something's flat in real terms, it means in nominal terms it's going up at about inflation. So a simple way to say it is profits have been rising over the last year or two by roughly inflation. You can see that if you go back to the early part of the pandemic, however, there was a huge surge, and that's because demand recovered faster than supply. Prices for almost everything went up. That created the inflation, this demand recovering faster than supply, even though it was still below trend. And those high prices did two things. It generated profits in excess of norm, and the other thing it did was encourage supply to come. And as that supply has come back on, you've seen inflation diminish. We'll come back to that. Go to the next chart. Industrial output, it's up about 0.5% year over year. It's above its pre-pandemic level. It got crushed early in the pandemic and has steadily come back, such that industrial output is up versus where it started. However, having said that, there is still some degree of lag, some degree of inflationary pressure from there. Go to the next chart. It's real, that is adjusted for inflation. Sales, as best I can estimate them through brick outlets, not including auto, by the way. And in real terms, it's high. And the nice thing about the retail sector is it's battle tested. If you go back 4 years ago, it was unclear how much online was going to steal from brick. Was it going to take all grocery sales? Was it going to take all sales? People had opinions, but you had not seen the battle test. What we saw in 2020, 2021, early 22 is they can't sell groceries profitably online. There's a whole lot of other products that can't be sold profitably online. They can be sold, they just can't be sold profitably. And so we have a much better sense. Also, you see that brick is still an important component. About 6 out of every $7 sold of retail are still being sold through brick. So it looks good. There are certainly bad centers, but there are a lot of strong centers as well. Go to the next chart is a kind of flip side of that coin, and I put e-commerce sales as a percent of retail sales, and you see they spiked. They deviated from anything like a trend. I put a red trend in there. It's obviously the visual trend. I'm not trying to suggest that is the trend, but rather I know that's what you'd be doing with your mind's eye, and I'm just kind of putting in the chart. It spiked, but remember it spiked when malls were closed. You couldn't shop on the goods side of Walmart. You could only stop on the grocery side, etc. And as reality returned, what you've seen is the percent has gone down. And it's heading back to trend, not necessarily this red trend line, but trend. And I think when it gets to trend, you're going to see this share pick up. I'm not saying that online sales are dead. It's just that there is a normalness to the whole thing. So very dramatic change. This is one of the things I actually got very right 3 years ago when I first started talking about what was going to happen, what I thought was going to happen. I got that one very right. Go to the next. Let's look at capital markets a little bit. And you can see 10-year Treasury. 10-year Treasury is not so particularly high. That's the red. It's bouncing around 3.5%. That's not so high in and of itself. The real problem is that the Fed about 18 months ago said, don't worry, we're not going to raise the interest rate. And oh, by the way, the last time we didn't raise the interest rate, it took us 8 years to raise it. A lot of financial players, right or wrong, took them at their word, took positions that went and played the yield curve, either on the balance sheet or on the asset side, on the asset or the liability side. The Fed then a few months later said, oops, we're kidding. And we were only kidding and raised the short-term rate by 5 percentage points in 12 months. Had they done that increase over 2.5 years, for example, it could have been adjusted to. Would there have been some pain? Yes, but too much, just too much. First of all, they've raised it higher than they need to. They've shown a tremendous arrogance of raising it even as banks are teetering. Why are banks teetering? Because they took the Fed at their word and they always played the yield curve. Their assets have gone down in value as the interest rate went up. The money center banks have lots of reserves, but the non-money center banks don't. A lot of the non-money center banks don't have sticky deposits. They don't have near the sticky deposits that the big banks have, who have smaller typical balances. And you have a phenomenon that rising short-term interest rates would have been uncomfortable to the financial sector, but wouldn't have devastated it, because you'd have spread the pain over time. Just think of an airplane landing. You don't just drop altitude instantly to land. You come down gradually. And there's a reason for that. It's not that you're not going to end up where you need to end up, but people can't deal with extreme changes, particularly after you told them we weren't going to change. The Fed has also failed at their oversight. They've completely misread inflation, as we'll come to in a moment. Go to the next. I mentioned the bank excess reserves. This is bank excess reserves. If you go back prior to the financial crisis, they had none, literally none. Therefore, any problem loan created a lender crunch. There are a lot of reserves out there. You can see they're falling, but they're still extraordinarily high. They're still higher than they were at the end of QE3. However, most of these are concentrated in the money center banks, and that's because when the Fed bought assets to create QE, they bought things that big banks held. They weren't buying loans, a $200,000 loan to a taco stand in Des Moines, Iowa. They were buying at inflated prices various treasury, high-rated bonds, Ginnies, Freddies, Fannies, etc. So the money that was pumped in almost all sits in a few money center banks who are well capitalized. That is a problem because most of America does depend on regional banks, because Wells Fargo is not going to make a loan on a $200,000 taco stand in nowhere America. They can't get their money out that way. So the Fed's policy has been reckless. They act as if they're driving a high performance automobile on a test track in perfect weather conditions. In fact, they're driving a beat up jalopy with bald tires on ice in a blizzard. They have some control, some impact on the economy, but not remotely what they think. The arrogance of the Fed raising the rate 25 basis points, days after SVB and days after First Republic, is breathtaking. You know, the old phrase, first do no harm, seems not to be something they find at all interesting. Go to the next chart. So where is inflation? So we've been playing with this, and instead of looking at year-over-year changes, we look at annualized monthly. Now you get more volatility out of that, but you get a more accurate picture of what is happening now. How are prices rising now? And you can see that up to this point, annualized inflation on monthly data since about December has been running between 2%, actually I should say almost 0% in March, to 4% last month, and it's been low. And don't lose sight of the March number. And by the way, don't lose sight of the December number if you go back and look. Quite low. So the Fed is looking year over year, year over year. Year over year tells you something about today, but it also tells you something about a year ago. I want to know the velocity that's happening, price increases today. Now, to that end, there is a serious flaw in the price indexes, in that they build in inflation for homeowners on their home costs. That doesn't exist. And if you think about it, a homeowner that owns their home has locked inflation out, right? There's no increase in their, maybe there's a little increase in their maintenance cost, but there's no real inflation there. And you add to that the data has built into it about a 6-month lag. We don't have time to go into why, but it's well known. And those of you out there on the apartment side know that rents are not rising remotely today like they were 6 months ago. And so you have this huge component of the price indexes that are reflecting what was happening in housing 6 months ago rather than a week ago. If you adjust this and you put in what's happening today, my estimate is inflation is somewhere around 2% on a run rate currently, which is hardly frightening and hardly suggests you need 5% interest rate on the short end. Go to the next chart. Why is it that inflation is in fact back down to around 2%, maybe less? And this is the Federal Reserve's index of supply chain pressure. You can see it's very volatile historically, but you can also see during the pandemic recovery, it went to basically 4 standard deviations. 4 standard deviations is we've never seen anything like this remotely before. When you've never seen anything like it remotely before, it explains why you've never seen an explosion of inflation like that before, because across the economy, demand recovered faster than supply. However, this index is basically back down to normal. Nothing special. Gee, do you think that's why prices have fallen? You go on to the next chart, you see that in fact, year over year, the money supply, at least measured by M2, which is big difference. 50 years ago, M2 was a very good metric of the money supply. Today, less and less. Does it include Bitcoin? No. Does it include PayPal? No. And so forth. So over time, M2 has become a less reliable measure of the money supply, but it's down about 2.5%. But it did rise dramatically during the pandemic. However, go to the next chart, you had an enormous drop in the turnover of money. And I've circled how dramatic those drops were. And so if you go back to the far left of the chart, through the 50s, 60s, 70s, the velocity was pretty steady. The turnover of money was pretty steady. So if you put more money in the economy, the velocity didn't change much, and you saw prices go up. And then you saw you put more money into the economy, and velocity went down dramatically. People saved the money rather than spent the money. They put it into assets, they invested it. You saw asset prices go up, but not consumer prices. And so the old MVPY kind of equation, for those of you familiar, is increasingly flawed because velocity is not stable. All you have to do is look at this chart to see that. And on top of that, M, the measure of the money supply, is increasingly flawed. So while I was trained as a monetarist, I realized the difficulty of this as velocity is highly volatile and counter volatile to money supply increases. So it's a challenge to use the normal. Go to the next chart, you can see the velocity going down because you see checking accounts and currency skyrocketing versus any kind of long-term trend, to the point where there's like $7 trillion of excess cash that will ultimately seek a home. Then let's just go to a couple more things, Bruce, and I think I'll stop for questions. Asset prices. You see S&P 500 down year over year 9.3%. I don't know what it's doing today. It was pretty flat earlier when I looked. Remember that asset prices are part of prices. So yes, we have probably consumer price increases of around 2% in real time. But remember, we've got asset prices falling. I use S&P as a proxy, but you know what's happening to real estate prices, even home prices, in spite of a shortfall of housing. When you factor in those as prices, the actual inflation is even lower than we've talked about before. And the Fed is just kind of ignoring it as if it's not part of an inflationary picture. Go to the next chart, oil prices. Oil prices have plummeted. Some of that stuff I talked about in Georgia, but other ways for the oil to get out and then goods to get in to Russia. They're down 37% from June 2022. It's pretty stunning. We got this one right. And I think you could still see more declines in this. Couple of last things. The debt ceiling is stupid. It's like running, you know you're going to run out of gas. You refuse to pull over and fill your tank. You refuse to make any changes. The other analogy I used was you told your kid you're not going to feed them unless they clean their room, and you keep telling them that, and your kid keeps saying, but I'm not going to clean my room, because they know you're going to feed them in the end. They know you're not going to starve them to death. And so it's just, what's the deal that's going to be made? Is the kid going to be able to not really clean their room, but kind of clean their room? And you aren't going to give them their favorite meal, but you're going to give them food. That's what's going on in Congress. And it's just pure political theater. It's not existential, though obviously if it was truly real, it'd be existential. If you truly weren't going to feed your kid, if they didn't clean their room and the kid's never going to clean their room, that'd be existential. But you know it's not going to happen. So I'm not terribly worried. The other thing is, you hear about the headline number of some $31 trillion in federal debt. But when you look at how much of it is held not by US government agencies, including the Fed, and not by one citizen in the United States for whom it's an asset, and another citizen in the United States for whom it's a liability, but foreigners, that's our real true debt as a people, that's not so staggering, right? That's some number around 7 trillion on a $24 trillion economy. So it's a lot of money, but it's not ridiculous. Bruce, I think what I'd say over the next few charts, people can download them, but rather than us showing, I've got industrial where real rents are at. They're high. Multifamily rents have peaked and have probably fallen in the last 6 months relative to inflation by perhaps 4 or 5%, adjusting for inflation. Office rents are nearing their all-time lows, quickly nearing those, and are way below average in real terms. Retail rents, good spaces leasing, bad spaces not. Overall, they're near all-time lows. Hotel RevPAR, adjusted for inflation, back above average, still probably on the range of 8% below where it was at pre-pandemic, but improved. And then the last thing, Bruce, if you'd put up the big questions abound. Yep, there are still big questions abound. Is inflation over? I believe yes. The Fed, I don't know what they're smoking. I just don't get it. And when I say I don't understand it, I truly don't understand it. How long will asset deflation continue and how low? depends on how long the Fed keeps reducing the amount of liquidity in the system. Long term, there, as you saw, were a lot of reserves. There's a lot of dry private equity powder out there. It will recover, but we've got a serious lender strike going on. I was hoping it would be resolved by now, but the Fed's insistence on raising interest rates higher and higher, as we talked about, has really hurt the regional banks a lot. Will the Fed raise rates too high? They always do. Either they're too low or too high. They're too fast. Go back to they believe they're driving precision. They always are late. They always overreact. Is regulation slowing economic growth? Is the increase in regulation slowing economic growth? Yeah, the most reasonable estimates would be around 0.3% of GDP is the slowing pace of growth associated with the increasing regulatory burden. A lot of that in the environmental area. And will people work at offices again? I believe yes. I keep talking to more and more people. They keep telling me increasingly so it's more productive to have people in the office. It's very hard to maintain culture at a big company and a dynamic company without having people back in the office. Interestingly, the people who should most want to be in the office are the ones who don't want to be in the office. There's this famous marshmallow experiment done years ago where you offered children a marshmallow now, or if you can wait an hour, you get 5 marshmallows. And you found that most could not resist taking the marshmallow now. And in a funny way, that's what young people are doing with their career. They're taking the short-term, easy route of not working in the office. And the long-term cost of that is the 5 marshmallows, that they would have learned how to present better, they'd have learned how to work with others better, they'd have learned how to lead better. And in fact, you're doing your people a favor by bringing them back, even though they may not realize it. But in the meantime, the office remains a challenge sector. With that, Bruce, let me stop. And I thank everyone for their time and their patience with me.
Thank you, Peter. Insightful as always. We had several people write in regarding what was expected with respect to distressed assets, a big wave of distress occurring. And why do you think that the expectation was wrong and we're not seeing a tremendous amount of distress at the moment?
Well, a couple of reasons. We wrote about this in Linneman letter. If you're talking about apartments, most existing apartment owners had long-term Freddie Fannie kind of debt. So it was locked in. So the run-up in interest rates did not hurt most existing apartment owners. It clearly hurt developers, and it clearly hurt anybody who was with floating debt. But most apartment didn't have it. You add to that that since they took their loan, values were up quite a bit. So they may not refi as effectively as they hoped, but there was plenty of cushion. Industrial, you can pretty much say the same thing. They didn't have Freddie and Fannie, but a lot of people took 5 to 7 year debt. They locked it in 3 years ago, 2 years ago. They're in good shape, no stress. If they had short-term debt, they're facing difficulties. Developing, they face difficulties because of short-term. Good retail, same way, had long-term debt, and they locked it in very cheap. So by and large, weren't exposed, and there's not a lot of development, so a lot of those projects didn't even exist to get squeezed. Hotels, again, you had a very nice fundamental recovery. So, and it was something nobody would lend to for a couple of years, and you're back money there. The big sector that's a challenge is office. And office is a serious problem, a very serious problem, because even if you have long-term locked-in debt, you got 3, 4, 5, 7 years to go, you have a good tenant roll, and you have low debt, you're in good shape, and you wait and see what happens. But if you have debt maturing, nobody wants to lend. And if you had floating, you're really in trouble. And if you have a mediocre building that had high leverage, it's ugly. Now, it is so ugly that it reminds me of the scene in Blazing Saddles, Mel Brooks' Blazing Saddle, where the sheriff comes riding into town, and the townspeople see that he's a black man, and they all pull out their guns, getting ready to kill him. These lovely townspeople of the prairie back in the late 1800s. It's a comedy. And they all get ready to pull out their gun, and they all pull out their gun getting ready to kill him, and he cleverly pulls out his own gun and points it at his head and says, if you people don't back off, I'm going to shoot myself right here. And suddenly the townspeople don't know what to do, because they don't want the sheriff to kill himself, even though they're ready to kill him. And so they all sort of have a standoff and eventually put their guns down. And that's a little like the office sector, which is the lender's going to say, pay me, pay me, pay me, pay me. And the owner's going to say, no, no, no. And if the owner says, take the building, the only thing the lender wants less than not being paid is the building. And because if the owner, especially good owners, can't make the building work and can't get it leased and so forth in today's world, you know that the lender's not going to be able to do it. So everybody's trying to figure out that sector. There's going to be a lot of kicking the can down the road, especially with good sponsors.
Thank you. We've had a number of participants write in about, you certainly have strong opinions about the Fed, and I think that's a fair statement to make. I'll put you on the spot because they want me to put you on the spot. If you were Fed chair today, what would you do?
If I was the Fed chair today, I would have cut rates starting in November. So they would, by this point, be 75 basis points below where they are now. I would have probably cut them twice since November. So instead of being at 5, they would be down at 425 to 4, which, by the way, if you believe, as I do, that actual inflation, when you do a sensible analysis of the data, is 2 to 3%, is a very still an aggressive short-term rate. I think you'd see no difference in inflation having done that, because all the drop in inflation is due to these supply chain issues disappearing. You would not have had the degree of stress that you had on the regional banks who got caught out. I would not do forward guidance. It creates a false sense of here's what the Fed's going to do, and the Fed has been a terrible predictor of themselves. So you're not giving guidance, you're just giving random noise needlessly. I would not give forward guidance, and I would have the rate down at least 75 basis points below where it's at, perhaps 100, but I would have started that back in November, and we would have a very different banking system. And by the way, I know I said at a couple of talks in early December that that's what I would have done, is cut in November, and we wrote in Linneman letter in the fourth quarter issue that the Fed should have been cutting rates, etc. And the other thing I'd be doing is, if I am going to, I'm responsible for the oversight of the safety and soundness of banks. It was disgraceful that, I mean, it was easy to figure out the value of the bonds at SVB were way down. Didn't take a rocket scientist. Anybody could do bond finance analysis. Those were transparent assets. This wasn't like loans to a taco stand. These were very transparent assets. And yet they sat on the side even though they're charged with safety and soundness oversight. And I'd like to believe I would have created an environment where the safety and soundness oversight is actually trying to effectuate something. I don't know if I dodged it, but there you have it.
No, I think that's a pretty direct response. Thank you. So I remember when we did our webinar in January or February of 2020, and I distinctly remember saying, you know, everything's been going so great for so long, you know, I'm just wondering what's going to happen, and, you know, it can't go on forever. What's changed for you, if anything, in your outlook since, you know, the beginning of 2020 to now? We're almost halfway through 2023. Have you had any fundamental changes in the way that you look at real estate, look at the market, look at opportunity, look at risk?
Well, I mean, the main one from the time period you mentioned would be, while I'm a big believer in good office, it is a challenge sector right now. The interesting thing is, if you go to Tokyo, it's not a challenge sector. Everybody's back. And you go to Tel Aviv, basically everybody's back. Those sectors are functioning. I know it's a trivially small market. I was down to Grand Cayman with a client a couple of months ago, and the office market there, very tiny, is doing very well because everybody's back to work. And you can go in Europe, people are much more back to work. You can go in China, people are much more back to work. The challenge is really in the United States, where people just say, nope, I don't want to come back. And at some point, I keep saying, executives, you have to earn that pay. You have to do what is right for shareholders and get them back, even though they don't want to come back. And as you know, Bruce, many companies have been open the whole time. A lot of the real estate companies have been open the entire time. And yes, they lost a few employees. And if you ask most of them, they mostly lost their most marginal employees. And they've gotten on just fine. And I think that's what most people would find if they got their people back.
Great. Thank you. Any final thoughts as we wrap up here?
Well, yeah, I do. Besides, thank you for all your kindness and support to me personally, to Linneman Associates, our whole family, to Bruce. I'd like to thank everyone. We've all been kind of, I mean, the whole process is always, I try to say what I believe and why I believe it with as much clarity as possible, with as much eye to real data analysis, also connecting it to the real world as possible. I've never claimed to be a soothsayer or a perfect predictor. My challenge is to tell you what I think so that you can challenge your own thinking processes out there. And everybody knows I can be wrong. It's not like that I don't think I can be wrong. But it really is to lay out with as much clarity as possible why I believe what I believe, so that you can challenge your own thinking. I don't know if he's on the call. Bryce Blair was kind enough, an old friend, was kind enough to do a presentation to my charity students down in Kenya a few weeks ago, and the topic was career. How do you manage a career and do a career? And by the way, if any of you would ever be interested in addressing our Kenya kids, we do an hour Zoom once a month on Sunday morning. And if you've got something you'd like to talk to them about, I'd love to have you just reach out. But Bryce was doing on career, and as we got talking about it before he did the presentation, he said, well, how did you choose to become an economist? And I said, well, the truth is, as a little kid, I wanted to be a tarot card reader, but I found that it was technically too demanding, so I became an economist. And the point is, I try, and I've got a long career of trying, but I think as important as anything is our effort to give you the data, our effort to give you the thought processes. And the last thing I'd say, Bruce, is remember, real estate's a long-term assets. Try not to get too distracted by all the shiny objects. And Lord knows there's a lot of shiny objects out there right now.
Great. Thank you so much, Peter. Terrific as always. Well, unfortunately, we're not going to be able to get to any of the other questions. Just want to remind you, this presentation is a digest of what's presented in much greater detail in the Linneman letter, which is quarterly subscription from Linneman Associates, and more information on that can be found on the Linneman Associates website, which is shown on the screen here. And as a final reminder, if you register directly for this webinar, automatically receive an email link to the recording in about an hour. So thank you again to everybody, and we wish you all a good, safe summer, and see you back in a quarter. And thanks again, Peter.
Thank you.